You bought a rental property to build wealth. You did everything right. You saved up, you found a place, you got tenants in there, and then you sat back and waited for the money to start flowing in. But every single month, the numbers just don't add up the way you thought they would, and you're starting to wonder if you made a massive mistake. Here's the thing. You didn't make a mistake buying rental property. You made one very specific, very fixable mistake that is silently draining your cash flow every single month, and almost nobody talks about it. I've worked with investors across the country, from people with a single rental unit to people managing dozens of doors, and the same pattern shows up again and again. Smart people, hardworking people, people who did their research, and yet they're leaving hundreds, sometimes thousands of dollars on the table every single month because of this one thing. We'll get into exactly what that mistake is in just a moment. But first, if you're someone who is serious about building real cash flow from rental properties, and you actually want a system that does the heavy lifting for you, there is a program linked down below in the video description. Don't go check it out if you're totally fine losing money every month. Don't go look at it if you're comfortable watching other investors pull ahead while you stay stuck. But if you're ready to change that, it's there waiting for you. Now let's talk about what's actually happening. Picture this. You close on your property. You are genuinely excited. You've run the numbers 100 times. On paper it looks beautiful. The rent comes in, you pay the mortgage, and there's money left over. Simple, clean, done. Then reality hits. Month 1, the tenant calls. The water heater isn't working. You didn't budget for that. Month 2, you get a property tax bill that's slightly higher than you expected. Month 3, the unit sits vacant for 3 weeks between tenants, and suddenly you've lost over $2,000 in rent just like that. And by month 6, you're sitting at your kitchen table at 10 o'clock at night staring at a spreadsheet, wondering where every single dollar went. You're not losing your shirt, but you're not winning either. You're just treading water. And you're exhausted. That feeling is real. That confusion is real, and if that's you right now, I need you to hear this clearly. There is nothing wrong with you. You are not bad at this. You've been missing one piece of information that changes everything. Here's where it gets interesting. The mistake isn't overpaying for the property. It isn't choosing bad tenants. It isn't even the vacancy. Those are symptoms. The real mistake, the one that sits underneath all of that, is that most investors are pricing their rental based on what they paid for the property, instead of what the market will actually bear right now. Let me say that again because it is that important. Most investors set their rent once, when they first buy, and then they never touch it again. Or if they do raise it, they raise it by the smallest amount possible because they're terrified the tenant is going to leave. So they stay low, they play it safe, and year after year they collect rent that is hundreds of dollars below market rate, while their expenses, their insurance, their property taxes, their maintenance costs, they all creep up quietly in the background. You are working harder and harder for the exact same return, and in real terms, because inflation is eating your purchasing power, you are actually making less every single year you hold that property with an underpriced rent. Think about what that actually means over time. Let's say you're just $200 per month below market rate on a single property. That's $2,400 a year. Over 5 years, that's $12,000 that you didn't have to lose. $12,000 that could have gone into your next down payment, into renovations that force appreciation, into anything else. But instead it just disappeared quietly, month after month, because of one pricing decision you made years ago that you never revisited. Investors who understand this don't just set rent. They manage rent the way a business manages pricing. They study the local market. They track what comparable units are renting for. They understand tenant turnover costs, which by the way can easily run $1,500 to $3,000 every time a tenant walks out. And they use that understanding to make smart, strategic pricing decisions that maximize long-term cash flow without constantly churning tenants. And here's the shift in thinking that separates the investors who are actually building wealth from the ones who are just surviving. The investors who are winning aren't afraid of losing a tenant. They understand that a small rent increase to market rate, even if it creates a brief vacancy, almost always pays for itself within a couple of months. Because the math simply works out. And once they see it work once, they are never afraid to do it again. But the investors who are stuck, they are operating from fear. Fear of vacancy, fear of conflict, fear of the unknown, and that fear is costing them real money every single month. I've seen people hold rents flat for 3, 4, 5 years because they were scared to rock the boat. Then they finally get a rental market analysis done and find out their 2-bedroom apartment is renting for $400 a month less than every comparable unit on the street. $400 every month for 5 years. That's $24,000. Gone. Not to expenses, not to improvements, just gone. That hurts to even think about. And if you recognized yourself in that story, that's okay, because recognizing it is the first step. The second step is doing something about it. Now here's what the actual process looks like when investors fix this. Step 1 is getting a real picture of what the market is doing right now, not 6 months ago, not what your neighbor told you at a barbecue, not what you remember from when you bought the place. Right now, you go look at active listings in your area. You look at what comparable units, similar size, similar condition, similar location, are actually renting for, and you get a realistic number. Step 2 is understanding your tenant relationship. If you've had a good tenant for a couple of years and the market has moved up, you don't just slam them with a huge increase overnight. You communicate, you give them lead time, you do it professionally. A good tenant who pays a little more is infinitely better than a difficult tenant who pays market rate. Tenant quality has a dollar value, don't forget that. Step 3 is building a system so this never slips away from you again. That means reviewing your rent on a set schedule. Once a year at minimum. Every single time a lease comes up for renewal, you look at what the market is doing and you make a conscious, informed decision. Not an emotional one, not a fearful one. An informed one. And step 4, the one most people never get to, is looking at the entire cost structure of your property, not just the rent. What are your insurance costs versus what comparable policies cost? When did you last appeal your property tax assessment? Are you tracking every deductible expense properly so you're not overpaying the government? Because every dollar you save on your cost side has exactly the same effect on your cash flow as raising your rent by that same dollar. The investors who are building serious wealth are attacking it from both sides simultaneously. This is where the gap really widens. The people who do this, who treat their rental like a real business, who stay on top of market data, who manage their costs, who price their units correctly, they don't just earn more cash flow, they build a track record of strong performing assets that compound over time. One property that cash flows well gives you the confidence and the capital to go get a second. The second gives you what you need for the third. And suddenly you have something that is actually working for you instead of just draining your energy. The people who don't do this stay stuck at one property, or two, perpetually wondering why real estate investing isn't delivering what everyone said it would. Not because it doesn't work, it absolutely works, but because they never got the right system in place to make it work for them. The difference in 5 years between someone who fixes this mistake today versus someone who puts it off is not just in dollars, though the dollars are significant. It's in options. It's in freedom. It's in what you're actually able to do with your life. Time is the one thing you cannot buy back. Every month that passes with your rental underperforming is a month of progress you cannot recover. That's not meant to scare you. It's meant to motivate you. Because the people who are thriving in this space, the ones you see buying property after property, the ones building real passive income that actually looks passive, they weren't smarter than you. They just had access to the right information at the right time, and they acted on it. And action, real action, not just consuming more content, not just watching one more video, actual decisive action, is the only thing that separates where you are right now from where you want to be. Which brings me to this. Everything we've talked about today, the pricing strategy, the cost management, the market analysis, the systematic approach that actually builds wealth, there is a program linked down below in the video description that walks you through all of it step by step. Not theory, not fluff. The actual mechanics of making your rental properties perform the way they were supposed to when you bought them. Most people watching this will nod along, feel that moment of recognition, and then go back to doing exactly what they were doing before. They'll check their numbers next month and feel that same frustration again. If that's you, that's fine. But if you're someone who actually wants to stop bleeding cash flow, if you're someone who wants a real system that has helped investors turn underperforming properties into wealth-building machines, then what's linked below is worth your time right now, today, not next week when things slow down. Today. Because the month you waste deciding is the month you can't get back.